This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 127 was recorded on July 19th, 2018. I'm Erik Townsend. Gluskin Chef Chief Economist David Rosenberg will be joining me as this week's feature interview guest. We'll discuss the reasons why David thinks that we're very late in the market cycle and defensive portfolio positioning is the prudent course of action. David is perhaps best known as the author of Breakfast with Dave, one of the most respected daily market letters in the industry. Now, Breakfast with Dave is a subscription letter which you have to pay for, and because it's so well known, Gluskin Chef rarely gives out more than a 7-day free trial for new subscribers. But once again, MacroVoices negotiator-in-chief Patrick Ceresna was able to strike a deal and score a full 1-month free trial of Breakfast with Dave just for MacroVoices listeners. So be sure to listen in for details on that offer at the end of the feature interview. We've also had a few requests recently to cover the agricultural commodities markets, and specifically to address the question of why grains continue to sell off even as signs of inflation are picking up everywhere. So be sure to stay tuned for our post-game segment after the feature interview, when Angie Setzer, also known as the Goddess of Grains, will join us to discuss wheat, corn, and soybeans, which have been extraordinarily weak in recent years. Patrick and I will also discuss strategies for hedging equity portfolios using S&P 500 index options.
And I'm Patrick Ceresna. Now, Erik, that S&P 500 cleared the 2,800 level, but initially I thought that would spark some follow-through buying up on the upside, and we really seem to be just pinned at this higher level with no real upside follow-through. Any first impressions here now that we're above here?
Well, I don't know. I mean, as you say, last week it was all about, round number resistance at 2,800. We got through it up to 2,814 or so. I think that was a number where we saw some resistance once before in this market. And, now we're coming back down and we're retesting today. I think we just barely retested 2,800 from the other side as a support level. So I guess I'd agree with you that there's not been a huge amount of bullish exuberance. It's not like, jump for joy, it's breaking out, everybody pile in. But at the same time, I haven't seen any bearish sign either. It's just been kind of muted upside breakout that looks to me like it still has legs, but maybe not a whole lot of momentum, not a whole lot of exuberance behind this one. So the big question is, how far does it go? If you look at where the channel resistance line shows up on the chart, you could make the argument that we're headed back towards January's highs. So the big question in my mind is, do we see a failed rally that's well short of the previous highs and a move to lower lows, or do we see a double top here, or do we actually move on to new all-time highs? And I really feel like anything is possible, Patrick, and the reason is that the news flow is changing so rapidly. 1 minute trade wars are on and it's the end of the world. The next minute, we're just kidding. Do we have a major problem with OPEC and Saudi Arabia and Russia increasing production? Too much? No, wait, it's not enough. Make up your mind. So there's so much that's changing so quickly. I think the news flow is going to affect this. The real question in my mind that we need to see play out here is what's going to happen. And since I have no idea how this is going to play out, because I think it is news flow dependent, the question that brings to the front of my mind is, how do you hedge the tail risks? Because a series of news events all going in the same direction could set us up for a big move in either direction. So let's come back to that subject in our post-game segment after the feature interview with David Rosenberg.
Okay, let's move on to that U.S. dollar index, because this morning we literally had a fresh new high. It was closing above its June highs, and then we gave a little bit back. We're still obviously above the 95 handle. It really feels like some momentum is slowly building here. Do you think that this is going to develop into a full breakout in the dollar index?
I think it probably will, as you say. We were up to 95.50, I think. We were really looking strong. And then President Trump made some public comments this afternoon that said basically, the strong dollar and higher rates is not good. And, he's the president of the United States. He can definitely talk the market back down in the short run. Even in the wake of those comments, we're looking just after the closing bell at, I see 95.02 on the futures contract on my screen. So we're just barely above the 95 handle, even on a day when the President of the United States was actively trying to talk it down. So I'm going to call that an actual breakout above 95. Normally when it's right on the line like that, it's kind of hard to call it, but to happen in the face of this jawboning in the other direction and after touching 95.50 on the day, feels to me like we've got more upside coming in this market. Could be wrong there. Maybe the president will continue with the jawboning to the other direction. We'll see what happened. But my feeling at this point is until the president's comments, we were really breaking out very aggressively. It's totally expected that those kind of comments would put a damper on things, at least temporarily. They didn't even bring a close below the 95 round number. So I think that moving ahead to a higher number above 95 by the time we talk next week is more likely. Now, who knows? We could see this was a false breakout and we're looking at 93 and change next week. Market loves to prove people wrong, but if I had to take a guess here, I think we're headed higher.
All right, well, let's move on to crude oil, and let's start off with those inventory numbers. How did everything come in this week?
Well, it was the exact opposite of last week. As you recall, last week we had a great big drawdown, a record drawdown in crude oil inventories, which would normally be super bullish. The market ended up selling off anyway. This week, crude oil building 5.8 million barrels. That was against an consensus expectation of analysts for about a 3.6 million barrel drawdown. So a massive, massive beat, great big inventory build. Cushing, Oklahoma, drawing down 860,000. That one is a drawdown, but not nearly as big as we've seen in recent weeks. Gasoline drawing down 3.2 million barrels. Distillates drawing down 371,000 barrels. So you would think, again, that we've got a great big build that was a surprise and that would probably send the market straight down. And, of course, we ended up with a knee-jerk down very briefly, and then it's been pretty much all up from there. And we are trading back off down just barely below $68 as we're speaking late on Thursday afternoon. Who knows what's going to happen here, but my analysis generally is the market was oversold. The exhaustion was already there to the downside, and even though that number should have been bearish, I think the market had already sold off as far as it wanted to sell off and was a little bit exhausted. That's the only explanation I can give you for why we saw this bounce over the last couple days. That is starting to soften now as we look at things on Thursday afternoon, so it'll be very interesting to see what the next week brings.
Okay, well, what about those time spreads we've been following so close in the last couple of weeks? What's new on the term structure?
Well, Patrick, quite a bit to report on that front, and there's something I wanted to start with for those of you who are new to following time spreads. One of the biggest mistakes that people make is they'll think, okay, I'll watch this spread contract until it gets to its expiry, which would be when the first month in that 2-month spread hits expiration, at last trade date of that futures contract. The thing is, when you look at it that way, you tend to get obscured data because on the very last day, just about anything can happen. There's extremely thin liquidity. You remember we had a chart up a couple weeks ago where we saw that the backwardation was about $2 the day before and the day after, but right on that contract expiration date, it moved to $12. That's not a real number. That's an anomaly that's going on because there's almost no liquidity on the final day of trading. So options expiration day, which is 3 business days before the contract expiry, is a much more meaningful date to watch as kind of the endpoint. And there's a very common phenomenon often on options expiration day. You'll see the expiring spread, that is the spread between the expiring month and the next month, will kind of take a nosedive on the morning of OPEX day, and oftentimes it hits a low and then drifts higher after that. A lot of people think that's because of the pinning effect of options that are expiring. Obviously, it's options expiration. I actually think it's something else. A less known fact is that on that same day, 3 business days before the last trading day, that's when that final contract goes into spot month status, which means that speculative trading limits are imposed. Doesn't matter who you are. If you have speculative positions, you have to be under 3,000 contracts. Now, for you and me, Patrick, it's pretty easy to stay under 3,000 contracts. But for the big boys, that really means they have to close all of their big speculative positions out on OPEX day. So to me, OPEX is kind of the end of the game for these spreads. What we saw is, sure enough, they took a nosedive on Tuesday, which was options expiration day, with that front spread, that's August to September, trading all the way down from over $1 to just about 60 cents on mid-morning on Thursday, around 10:30 to 11 o'clock. So you think, okay, as options expiration approaches, that spread comes back down. That means that maybe this situation that the market was so spooked out about is over now and things are getting better. Well, holy cow, Patrick, from a low of just about 60 cents, maybe it was 59, it's hard to tell on the chart that I'm looking at right now, mid-morning on Tuesday, we actually got all the way back up to $1.80. So way more than $1 of upside in the last 48 hours on this contract. And that says to me that something is still very broken in terms of physical oil supply in Cushing, Oklahoma. And the reasons for that, Syncrude is back online. The explanations that were given before don't seem to really apply, but something is still fishy here, and those spreads are still behaving in a very bizarre way. I think that is definitely contributing to the reason that the Brent WTI spread has come in so much and a number of other things. I still feel like the fundamental underlying cause of this is an unknown. A lot of people have cited good reasons that explain parts of it, but I don't think we've really seen it all yet. Well, what's going to happen next? Are we going to, right now we're looking at $1.67 on the next contract after trading above $2 today. Right now, that second contract, that's the September-October contract, traded above $2 today on that spread, and we're looking at 1.68 as we are just after the closing bell on equity markets before the commodity close at 5 o'clock, and I'm looking at 1.68. That is just a huge number for what is about to become the front spread, and it indicates a serious supply problem. So what's going on here? When we look at this a month from now, as that September contract is about to expire, are we still going to be looking at huge numbers, or is it going to come down below 50 cents, which would be in line with historical norms? It remains to be seen, and I think it remains to be seen what the real cause of this has been, Patrick.
All right. Well, let's move on to the bigger picture here, Erik, and what you think is going on in oil, because I was sharing with my members this kind of idea that the next rally in oil was going to tell us everything, because if the next rally in oil fails to make higher highs, then boys, it's going to start sniffing like a topping formation developing in here. I feel it's a little too early to make that call, but does that sort of fit your narrative as well, or do you have some different view on that?
Yeah, I guess the way I would have expressed it is my conviction directionally is very low right now. I don't really know what's going to happen next. There's a lot of reasons to think that the bear case stays in play here. We've got Russia and Saudi Arabia increasing production. Now, they came out today and said maybe they're not going to continue to increase production as quickly as they have been. There is discussion. The president continues to tweet and make a lot of noise about how he wants lower oil prices. That causes a lot of people to start to speculate that a strategic petroleum reserve release could be in the works, where the government sells SPR oil into the market in order to suppress the price. So there's lots and lots of reasons that you could be bearish here. On the other hand, there's plenty of reasons to think that between Venezuela falling apart and the excellent arguments that both Anas Al-Haji and Joe McMoneagle made a few weeks ago when we did an oil special, they made some very good bull arguments, and I think they all make sense. There's so much, lack of certainty here. What is really going on behind these time spreads? What is that factor? Why has the Brent WTI spread narrowed so dramatically? I'm open to a lot of possibilities here, and I could see a big move in either direction, up or down from here. And I agree with you. We got to let the market tell us. So if you see a rally that goes to new highs above $75, then that definitely speaks to the strength of the market. It's hard for me to see where we go a whole lot higher than 75 on WTI and 80 on Brent, because at that point, you've reached the point where the people who were trying to engineer higher prices have pretty much hit their objectives. I don't think that Saudi Arabia and Russia want $100 oil right now. That would do too much to restart the U.S. shale boom. They don't want that. So I don't think they're going to continue to try to engineer an increase in prices above $80. On the other hand, if you see the geopolitical situation continue to deteriorate, who knows what could happen next in this whole post-Trump-Putin summit rift. The Democrats want to literally impeach President Trump and try him for the crime of treason because of the way he handled the press conference with Vladimir Putin. In an environment like this, who knows what could happen next that sends prices temporarily racing to the upside. But I don't think you're going to see Russia and Saudi Arabia trying to engineer them a lot higher. On the other hand, where could the downside go from here? It really depends on how much influence President Trump, wants to assert and continues to assert. It also depends on other geopolitical things. If Venezuela starts to get its act together and stops losing production, that could help to change things. Syncrude is back online. On the other hand, if things are getting better, boy, it sure is not showing up in those front two WTI spreads. So I think there's a lot of mixed signals, and as you say, we got to watch the tape and let the market tell us what comes next.
All right, well, let's move on to gold, because gold just continues to deteriorate. It looks like we're on autopilot to 1,200 here. What's your thinking on gold?
Yeah, we almost hit 1210 earlier today, and frankly, it's no surprise whatsoever. We knew to expect this, and in fact, we predicted it here on this program in recent weeks. What we've said is the reason to buy gold is if you think the U.S. dollar is done here and it's about to roll over and crash. Well, guess what? It's not doing that. Until President Trump's comments today, it was racing to new highs well above 95, looked like it was headed for a close north of 95.50 until President Trump talked it down. Is this the beginning of President Trump talking it very aggressively down, or was that comment just a one-off? Well, that remains to be seen. So we have to wait and see what the tweeter-in-chief does next. It's going to be all about the dollar, though, as far as I'm concerned. The gold story is the reciprocal of the dollar story. Make your decision about what you think the dollar is going to do, and gold is going to do the opposite. So if I'm right about the dollar rally continuing, and I think that is likely unless President Trump gets really aggressive about making this an issue and tweeting about it every day the way he has with oil recently. If the dollar continues to rally, I think there's more downside to gold. Now, I definitely think gold will have its day in the sun. We're seeing signs of inflation on the horizon. Gold's been in a bear market, then it was consolidating for quite a while. We haven't seen any real bull market kind of action yet, and we're overdue for it. The thing is, I think it's not quite yet. For long-term buy-and-hold investors, I suppose you could make an argument. Maybe this is not a bad place to start scaling in. Certainly, buying here at 1,200, it's not that bad of a place to be. But I think it's entirely possible if the dollar really rallies and Mr. Trump does not do too much to arrest that rally, I think that we could very easily see a new low below 1,000 before this is over. So if you're buying here, I think you've got to have a very long time horizon. As far as shorting here, I think that you probably missed that opportunity. Wait for a bounce if that's your shorter term trading conviction. At this point, I think it's probably not time yet. On the other hand, we never know. They don't ring a bell at the top and they don't ring a bell at the bottom, but most experienced traders will tell you that trying to call tops and bottoms is not a smart move. We certainly don't have an established uptrend here, so if you're going to buy, it's got to be from a very long-term perspective that you think these numbers are attractive to start averaging in, and you've got to be ready for the price to go considerably lower before it eventually goes higher. Now, I'll be quite surprised if we don't make new all-time highs above 2,000 $2,000 an ounce, let's say, in the next 5 years. But 5 years is a long time, and I wouldn't be surprised if there's a little bit more downside before we start seeing big upside.
You know, Erik, the one thing actually I wanted to include in the chart book for the post-game for today's show is I wanted to touch on this yen-gold correlation chart. I mean, obviously, it's something that some really smart traders have talked about in the past, but I wanted to sort of speak to it. So let's touch on that actually near the tail end of the post-game after we're done with the interview. Now, I want to move on to the 10-year Treasury yields, which almost broke out above 290 and then quickly gave it right back. And we're pretty much selling at the same level on yields at the 2.84 that we were in the last show. I mean, we haven't really seen anything. What's your thinking on the 10-year Treasury yield consolidation?
Yeah, we're down a whole basis point from last week. We were 2.85 is what I had written down last week. We're 2.84 right now. So, as I've said before, I think this is the big consolidation. I wouldn't be surprised if it lasts till Labor Day. The big move that I'm watching for is the decisive close on the 10-year below 2.60 or above 3.10. I think that's what marks the next really big, significant secular move. As far as shorter term trading, the swing in between, I really don't have an opinion on it. Down here at 286, we're kind of at the low end of the recent range. A close below 280 that lasts a couple days would probably be a sign that a test of 260 might be coming. We'll see what happens, but I think we have to wait for a decisive move either above 310 or below 260, and I don't see it happening right away.
So this week's featured interview guest is David Rosenberg, chief economist at Gluskin Sheff and author of the Breakfast with Dave newsletter. Erik's interview with David is coming up as MacroVoices continues right here at macrovoices.com.
And now with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me next on the program is David Rosenberg, famously the author of Breakfast with Dave, a newsletter which has persisted through, I think, 3 or 4 different job changes. Dave, thanks so much for being with us in the program. Listeners, we've got a great slide deck that Dave put together actually a few months ago. This is dated from March, but it is every bit as relevant today as the day that it was published in March of 2018. You'll find the download link in your Research Roundup email, and I strongly encourage you to download it as we'll be referring to it throughout this interview. Dave, the first few slides you've got here, you've done such a brilliant job, as always, in getting some of the smartest people and quotes from them in the industry together, all kind of on the same theme, which is we should be pretty much coming to an end of this cycle. But I was particularly caught by Jeremy Grantham's comment on page 3, where he says, this thing ought to be over. But on the other hand, as a historian, there's also the possibility that we're just going to see a great big blow-off or melt-up phase at the end of this bull market. And he's seeing the potential of maybe another 60% surge up before it's finally over. So where does that bring us? This was a few months ago. What's the current update on your outlook on the market? Are we looking at maybe that last hurrah, or is this cycle finally ending?
Well, I think it's probably more the latter. It's interesting that Jeremy Grantham made that comment just as we were hitting that January 26th peak in the S&P 500. I think actually the blow-off already had happened in January when heading into the all-time highs, the S&P 500 was up almost 8%. And, that doesn't happen every single day. That was in less than a month. And I remember all the headlines saying at the time that this was the best start to the year, the best January we've ever seen since 1987. And my retort was, well, when I go back and poll people about 1987, January is not the month they remembered. It's October. So I would actually say, I don't know where 60% increase in the stock market from where we were in January, where that would possibly come from. But my sense is that the blow-off phase already happened after the tax cuts were announced in December and into January. I think that was the last, parabolic move to the highs. And we just put in a classic topping formation ever since. This market is looking very toppy. The breadth measures are looking increasingly, less impressive. And the yield curve is flattening, not inverted yet. But my sense is that, some indices like the NASDAQ put in a high very recently. You can look at the Russell 2000. To me, the S&P 500 is the bellwether. And until otherwise notified, it's been a good 7 months since we last saw a high. And until we revisit that, to me, this is a classic choppy trading pattern of the market.
You've got absolutely fantastic content throughout this slide deck. Listeners, I strongly encourage you to enjoy every page of this. But in the interest of time, I'm going to skip ahead to page 42, where you get into this huge overhang of corporate debt that is just one ratings downgrade away from being downgraded to junk status. And of course, there's a reinforcing cycle that always kicks in there. If things get downgraded to junk, institutional holders are forced to sell them. They don't have a choice because they're no longer in investment grade, and that just pushes the price down further. But a whole lot of people have been speculating that that's what's going to really give out next is going to be the junk bond market. But I also noticed, I just saw this week that we've got record high short interest in the junk bond ETFs. And of course, that could be a setup for a short squeeze. So do you think this junk bond market is finally ready to let go here, or do we maybe still have more time to wait?
Well, what's interesting is that the real excess might not even be in the high yield market, but actually more in the investment grade market, because, at the peak of the last credit bubble over a decade ago, only 30% of outstanding debt in the investment grade universe was triple B. Today, that ratio is 50%. So it's really the junkiest investment grade universe, that we've ever seen. The reality is that a lot of the energy companies and the high quality ones, during the downdraft in oil prices a couple of years ago, they got pushed in to the high yield index already. And with oil over $70 a barrel than say 30 or 40, they're pretty well allowing the high yield index to hang in relatively well when you consider they're 20% of the high yield market. The real excesses actually are in the investment grade universe this time around. And my sense is that, the Fed seems to have this very rosy scenario, steady she goes. Jay Powell told us that he doesn't sleep at night over the economy. Sounds a lot like Ben Bernanke talking about how the problems of subprime are going to remain contained. And it's not a matter of timing. It's really a matter of understanding where we are in the Fed tightening cycle. And at some point, given how much leverage there is in the corporate bond market, not just high yield, but investment grade, and the record volumes of debt refinancings taking place in the next few years, because we will be paying the piper at higher interest rates, the default rate's going to rise, credit spreads are going to widen out, financial conditions are going to tighten, and that's going to generate the inevitable recession. And it's not a matter of if, it's a matter of when, and I could be early on the call like I was back in 2007, but I am suggesting that people, if you don't open the umbrella, just make sure you have one on you.
Well, I think you make an excellent argument where the excess is really in the triple B rated corporates as opposed to what's already been downgraded to junk. Is there a way to play that? The ETFs, JNK and HYG, are such an easy way to short junk bonds. Is there a similarly easy way to short these triple B rated corporates?
Well, I would say that it's very difficult to short anything that's naked in terms of that earns a carry, because you take that negative carry if you short it. So you really have to benchmark it against something else. My sense is to go long within the credit space, go long the high quality, more defensive names that have strong balance sheets, go long those names, and go short the low quality names. And I think that's how you're going to be able to at least hedge against interest rate exposure, but also, I think, capture the lack of quality and the lack of basically debt repayment prospects down the road. I would be shorting the low-quality stuff, but go long the high quality against it. That's how I would hedge that situation right now.
Dave, moving on just a couple of slides, you got into the subject of inflation, core PCE inflation peaking lower and lower. This is a subject we've heard quite a bit about from recent guests on the program. Some people very much committed to deflation has got to be the name of the game, or disinflation. Russell Napier recently telling us that story. On the other hand, other people are saying, yeah, but look at some of these numbers like PCE starting to turn up. We're maybe on the cusp of a return, according to some people, of secular inflation. How do you see this short, medium, and long term? What's going to happen with respect to the inflation or deflation trend, and how do you play it?
Well, look, I'm not going to try and obscure what is secular and what is cyclical. To me, that's a complete waste of time. We had secular deflationary forces in play in the last cycle, whether it was China's ascension to WTO, the same story about aging demographics, technology was still advancing. You could argue even more so now. It didn't stop underlying inflation, in the mid-2000s from going from 1% to 3%, and headline almost got to 5%. So these cyclical inflation pressures, they don't last 1 or 2 months or 1 or 2 quarters. They could last a couple of years. And so if you look at the chart, you'll see there's a long-term secular downtrend. That much is true, but it gets punctuated by these late-cycle inflationary pressures that only a fool would ignore, because I don't think anybody can afford to not have at least a 1, 2, or 3 year view. The data are the data. Inflation is going up. Every single piece of measured inflation data are rising. The New York Fed's underlying inflation index, which is a great leading indicator, has already broken out to a cycle high and is suggestive that underlying inflation is going to be rising. The demographic story hasn't changed. Technology hasn't changed. Certainly debt constraints on aggregate demand globally, that hasn't changed. What's changed is the trend towards globalization. What is new is that we have the risk of a global trade war. Tariffs are already going up. That's creating cost-push inflation at a time when there's very little slack, if any, left in the U.S. economy. That's going to be inflationary. Really, for the first time since the Vietnam War, we're running a pro-cyclical fiscal policy at the peak of the cycle. We know how that ended up after the Vietnam War. It ended up years later with higher inflation. So you're taking a look at the shifts in the United States towards fiscal policy. You're looking at the shifts towards global trade policy at a time of 4% unemployment. I mean, you can't ignore these other powerful offsets. So my sense is that the secular story still may be intact because of technology and demographics. But I think that for the next several months, quarters, maybe even the next couple of years, the trend's going to move towards moderately higher inflation. And I'm not so sure the markets are fully priced for that.
Let's skip ahead to page 52 in the deck here, where we talk about the U.S. dollar trend. Hearing so many different views on this recently. Do you think that the current bounce in the dollar has legs? Are we seeing a reversal of trend, or are we still headed down as a lot of people? It seems like everybody predicting the crash of the dollar, but it's not happening.
Well, I don't know why people would be predicting the crash of the dollar, but I would say that, so long as the Fed is the only game in town in terms of raising interest rates and everybody else is on hold, maybe outside the Bank of Canada, in the developed world, interest rate differentials are going to continue to work in the favor of the U.S. dollar. So my sense is that, the path of least resistance, in my view, at least say in the next, 6 to 12 months, I'd be very surprised if the U.S. dollar were to succumb into a downtrend, unless something happens that causes the Fed to back off, or something happens that causes the ECB or the Bank of England or the Bank of Japan to start increasing interest rates. The ECB, which is a key part of this relationship with the trade-weighted dollar, has already told us that although they're going to be tapering their balance sheet, interest rate increases are way off into the horizon. So my sense is that the interest rate differential, which is the most important component in determining exchange rates, is going to remain in favor for the U.S. dollar for some time.
Let's move on to the 10-year Treasury yield. There were so many smart people predicting, hey, there's a magic line in the sand, 3.05 on that 10-year yield. If we go past that, baby, it's no return. It's the end of the world at that point. Of course, we did go past 3.05 all the way to 3.11, I think. And now we're right back down to 3.80s again. What's going on here, and where do you see it headed?
Well, we're in a very tight range now for the better part of the past 4 months. And I think you were correct in saying, 3.1% at the high end and call it roughly 2.8% on the low end, very tight range. And it's a tug of war, really, between concerns over economic growth once the tax cuts subside and the impact on the real economy, purchasing power for the consumer in particular, but also margin squeeze for the corporate sector, what that means for economic growth at a time when the Fed continues to take the carry away. So we're really in this tug of war right now. I think that what's very interesting is how investors are positioned. I mean, you were talking about, the short position in high yield ETFs. You go to the latest Commitment of Traders report, and you're going to see that in the futures and option pits, there's almost a record net short position on the 10-year Treasury note, almost 350,000 net short contracts. For the long bond, it's actually at a record of over 190,000 contracts. So, If you adhere to Bob Farrell's rule number 9 about all the experts and forecasts agreeing that something else is going to happen, you got to start thinking that the sellers of treasuries have already exhausted themselves. We've hardly ever seen such a huge net short position for 10-year and 30-year bonds. That tells me that even a small piece of adverse news could cause a lot of these shorts to cover, and yields actually would be at risk of going down. People always talk about the risk of the Fed inverting the yield curve. What might happen instead is that treasuries may rally and cause that inversion from the longer end of the curve.
Moving on to slide 63. Now, of course, this was 4 months ago that this slide was put together. It says here that we're past the 7th inning stretch. 4 months later, are we all the way to the 9th inning? Is this really at the end, or are we still got maybe a little ways to go?
No, I wouldn't say that it's not the 9th inning. I think that we're still past the 7th inning stretch, and let's face it, in the context of economic expansion, that's the second longest on record. Heading into this 10th year, you can even be into the 9th inning right now, and it would still tell you that we have about a year left in the tank. It's just basically, not trying to time things, but trying to figure out, what segment of the cycle that we're in. And so we did a report looking at 15 different indicators, both market and macro variables, to examine the degree of capacity in the economy, how the pattern of the economy this cycle is evolving relative to what it's done in the past since the end of World War II. And we were able to ascertain that we're about 90% into the cycle, which means probably closer, to the 8th inning than, say, the 7th, maybe not quite the 9th. But what's important is that for investors is that there's early cycle investing, mid-cycle investing, and late cycle investing. It's not really about a recession. Recession will come, I think, more next year's story than this year's story. And so you don't want to be too early, even though you don't want to be late. But the major point is that across the whole continuum of the business cycle, there is an optimal asset mix and an optimal sector representation in your equity portfolio across that continuum. And late cycle is the antithesis of early cycle. So it really means you want to have some cash on hand. You want to be very defensive, earnings visibility and predictability in the stock market, and you really want to trade up in quality in the debt market. And you want to be focused on protecting the portfolio from late cycle inflation and rising short-term interest rates. And there's a variety of ways of doing that, without having to have too much cash on hand, although having cash on hand right now for optionality purposes to put to work at better valuation levels, say 12 months from now, is a prudent thing to do, in my opinion. And that's, again, that's classic late cycle, whereas early cycle, you don't want to have any cash at all. It's a lot different this time around.
Along those lines, Dave, we've seen year to date that cyclical stocks are still outperforming defensives. Do you expect that to turn around as we go into the second half of the year?
Well, it depends how you want to define, cyclical stocks. We've got technology has been the clear leader, up 15% year to date. And that to me is a classic growth story and a prevailing view that this is one area that is not going to be hurt, by the rising tide of populism and the reversal of globalization. That'll be put to the test, but that's the view. But tech is classic growth, and they have remained the leaders. You're going down the list. You can count energy as being an outperformer for sure, but, energy is benefiting from the fact that OPEC and the other suppliers got their act together with the output cut agreement, bolstered the price. It wasn't just a demand story, it was a supply story. Outside of that, there's not a lot of cyclical stocks that have outperformed. You look across the board and you see that the materials are still down 4% for the year. Industrials are down 3% for the year. If this economy was really booming like everybody says it is, you'd have to ask yourself the question, why would financials be down 2%? Why would the relative performance of the bank index be down to its lowest level in 12 months? So actually, it's a very bifurcated market. If you stripped out, the growthy tech index, the median sector so far this year is down 1 to 2%, and that includes the bounce back we've had over the course of the past couple of weeks.
You're in Canada, and we also have quite a few listeners in Canada. Let's touch on the Canadian economy a little bit, starting with the Canadian dollar. Is there more downside to the loonie in store as you see this situation continue to develop with respect to the late-stage market and everything else that's going on in the economy?
Well, a lot of that depends on what happens with NAFTA. For a country that is so trade dependent as Canada, how NAFTA goes, how this looming, if not looming currently, this global trade spat that could turn into a war. Countries like Canada, Australia, New Zealand, countries that have high trade orientations are going to get hit pretty hard. There's a lot of bad news already priced into the Canadian dollar at 130, 142. But I don't think that, a worst-case scenario that would involve, a NAFTA being abrogated is priced in. I think things could get a lot worse. I think right now, from a market positioning standpoint, and you always have to take a look at how the markets are positioned, there's a huge net speculative short position right now on the Canadian dollar in the futures options pits, over 50,000 net shorts. So there's a lot of the positioning right now would lead me to the view that the Canadian dollar could embark on some sort of near-term rally, but it would be more technical than anything else. My sense is that whatever the Fed does and the Bank of Canada does, the Fed is going to hike rates more than the Bank of Canada is going to do. The Bank of Canada is not confronting massive fiscal stimulus at the peak of the cycle. The Fed is. So I think that the interest rate differentials we talked about before are going to work increasingly against the Canadian dollar. I'm not bearish on the oil price, but I don't see us doing a lot better than $70 in WTI. So I think a lot of the energy story, well, positive, a lot of that is behind us. And I think people haven't factored in the fact that, the U.S. cut corporate taxes this year. The government of Canada did not cut Canadian tax rates, so that we have a competitive disadvantage with the U.S. right now for the first time in decades, where corporate tax rates south of the border are lower than they are in Canada. So that fiscal divergence leads me to believe that that the Canadian dollar is going to have to remain a weak currency to act as some sort of a competitive crutch offset to that. So I would say beyond the prospect that we get some sort of short squeeze that could help the Canadian dollar on a near-term basis, I'd say that the list of negatives outweigh the list of positives and leaves me overall, I would say, slightly net bearish on the currency.
A lot of people have declared the Canadian housing market to have peaked, saying, okay, that's it, it's over, and it's all downhill from here. Yet the downhill hasn't been very steep, if it's coming, at least so far. First of all, do you agree with that view that Canadian housing has peaked? And regardless of whether you do or you don't, what do you see next in terms of what happens with Canadian housing?
Well, I think that, unlike the U.S. in the housing bubble back in, 04, 05, 06, and 07, that was a national bubble. When you're talking about the excesses of Canadian housing, it's not really about Halifax, Ottawa, or Winnipeg, or even Montreal, although Montreal's turned into a hot market. Really, the bubbles were Vancouver and Toronto, which is not 100% of the Canadian market. It's 35% of the Canadian housing market. So this was not a national bubble. It was in two very large cities. I would have to say two very desirable cities to live in, that's for sure. And the source of support that you've been seeing is coming from large-scale immigration, especially skilled immigration coming into the country and supporting the markets in these areas. Household formation in Canada is running much stronger than it is in the United States because we have a much more, shall we say, open immigration policy, and that's a huge impact on housing demand. But when you're taking a look at the valuation metrics still in Vancouver and Toronto, it would be hard to claim that we've seen bottom yet. You asked the question about has housing peaked. In Vancouver and Toronto, they both peaked 18, 24 months ago. So housing here has definitely peaked. Sales and pricing have rolled over. There hasn't been any sort of destabilizing collapse, but there's no question that the housing sector has weakened off. And I think will remain very weak. This is not going to be a provider of growth for Canada for a long period of time. That story is well behind us. The question is going to be, when you consider that roughly half of the outstanding residential mortgages in Canada are short-term mortgages, they roll over in the coming year. The question is going to be how far will the Bank of Canada go in terms of raising interest rates? That's the elephant in the room. Because these real estate cycles can turn pretty nefarious, as we found out in the U.S., not just in the last cycle, but go back to the late 80s, early 90s. Central banks and interest rates have a lot to do with how far housing markets can go down. So I don't think so. Has housing peaked in Canada? Certainly in Vancouver and Toronto, the answer is yes. The question I get more isn't about whether they peaked, but have we hit bottom yet? And my sense is that, net on net, we're probably only about 2/3 of the way through this corrective phase. There's more to go.
Dave, finally, I want to touch on a 2-decade-old institution, which is Breakfast with Dave, although I suppose 2 decades ago it had a different name. You were one of the pioneers of doing a daily newsletter, not just weekly or monthly. And that started back in 1998 with the Bank of Montreal. When you moved to Merrill, first in Canada, then in New York, it really got super famous, I think, when you were with Merrill, and it's still with you to this day, and it's just fantastic reading. We've got a super deal. Normally, you have to pay a subscription fee to get this newsletter. We're able to get a 1-month free trial for MacroVoices listeners only. Listeners, in order to take advantage of that, all you have to do, there's no credit card required, no signing your life away. Just send an email to Marcel Alls at Gluskin Chef. Marcel's email is linked in your research roundup. Tell him that you are a MacroVoices listener, and you can get a free 1-month trial subscription. Dave, tell them a little bit about the history of this newsletter and what they can expect to find when they read it during their free 1-month trial.
Well, it actually started in 1998 when I was in the economics department of the Bank of Montreal. The person who took over the Treasury operations at the time, Bill Down, who ultimately became the CEO of the Bank of Montreal, pulled me aside one day and said, your morning meetings to the Treasury are great, but you speak too fast, as everybody here probably can understand after listening to me for the past half an hour. And he said, why don't you get down your thoughts on paper every day? We'll market it, but to prevent broken telephone, write down your thoughts on paper, call it something snazzy, and that was really the start of Breakfast with Dave. It was called something different back then. I think it was called AM Notes. And then, from there, basically, took me to Merrill Canada, then to Merrill New York, and then to Gluskin Chef. So really, it's a daily distillation of my views on politics, on economics, on the markets, what's already happened that's going to shape the outlook, what I think is going to happen in terms of the data in the coming days. So it's basically small picture and big picture. There's really 2 companion reports. There's one that comes a little earlier called Espresso with Dave, and then there's the Breakfast with Dave, the bigger publication. And like I said, it's just how my views are evolving every single day, and it combines a lot of small picture with big picture. It's really something that focuses on the forest and focuses on the tree simultaneously.
Well, Dave, I can't recommend it highly enough, and best of all, the first month is a free trial, so you can't beat free, folks. Again, all you need to do is identify yourself as a MacroVoices listener by sending an email to Marcel Alls. Marcel's email is in your Research Roundup email, and you'll be able to get signed up for the free subscription. Dave, thanks so much for joining us on the program. Patrick Ceresna and I will be back as MacroVoices continues right here at MacroVoices.com.
MacroVoices is a listener-driven program. Please email requests for specific future interview guests to requests@macrovoices.com. You can email questions for the program to mailbag@macrovoices.com, and we'll answer them on the air from time to time in our mailbag segment. We also welcome your suggestions for how we can improve the program. Now, back to your hosts.
Erik, what a great interview with David Rosenberg, and I want to get back to that interview in just a moment, but joining us in today's postgame is Angie Setzer, also known as the Goddess of Grain, because we wanted to really touch on these grain markets a little bit. So how you doing, Angie?
I'm doing good.
Angie, thanks so much for joining us. Before we get into the specific grains, the question that's on my mind is just what the heck is going on big picture here? Because grains have been selling off for a few years now, and everybody who thinks they've got a macro explanation for it, weighs in with what it is, and okay, they got to be bottoming now. And it seems like every time we think they're bottoming, for a while it was okay, as soon as inflation picks up, it's going to be all over, and grains are headed straight up from there. That lasted a little while. Now we've got inflation signs still ticking up. Grains selling off to new lows. Is there a macro driver here? Is there a technology change? Did somebody just build a whole bunch of new farmland that didn't exist before? What's going on? What's the big picture?
You think that the last option you gave is the funny one, right? But it's reality. high prices cure high prices in commodities for sure. And so one thing that we saw take place is if you look prior to 2005, 2006 timeframe, you'll see that the grain markets tend to trade in a pretty solid range. You could tell kind of where the low was and you could tell kind of where the high was. And unless there was a extenuating circumstance, with weather or some sort of other outside demand driver, you would see a continuous back and forth sort of pattern. Well, you look at 2006 and in corn specifically, you saw the ethanol boom take place. So we introduced basically 1/3 of new demand, about 5 billion bushel worth of new demand came into play between about 2006 and 2012. And so to look at the 2012 high of the market is a bit disingenuous because not only did you have that new demand come in via ethanol for corn and via your protein sectors for China, you saw the Chinese imports really pick up. We also had a generational drought take place that year. So we see a lot of conversation pointing back to what happened in 2012 as though that's an indicator that we should be heading back in that direction. In reality, as those high prices that we saw, those lifetime, once in a lifetime sort of pricing opportunities that a lot of farmers experienced helped create new supply. So you saw Brazil, if you look at what South American bean production and corn production was prior to 2010, and you look at Black Sea regions prior to that 2010 timeframe, you'll see that their production was relatively benign. It wasn't something that could really step in. And I think a lot of folks thought the U.S. would be, really the only provider to the world when it came to grain and oilseed demand. And the fact is those high prices really kind of encouraged producers that wouldn't have otherwise thought to do so to kind of grow and put some of that arable land that it may have been sitting idle or in pasture to use. And so we did see an increase in supply happen that basically outstripped the increase in demand. And inflationary pressure should come into play. It really did if you look between 2008 and 2010, but it's really hard to kind of ignore the overall supply and demand fundamentals that tend to trump that inflationary desire to see these markets move higher.
All right, Angie. Well, I want to just move on here, and I want to look more specifically, not just big picture, but specifically at some of these individual grains. Particularly, I want to talk about wheat. Now, wheat has held up much better than corn and soybean, and so far, obviously, through 2017 through to 2018, we saw lows come in around the 400 level, and we're nowhere near that at this stage. So we haven't seen that big throwback here. What's a little different about wheat from the other grains?
Right now, supply differences. If you look at the global supply and demand situation in wheat right now and remove China, a lot of folks will say that the overall global supply situation, or if you look at ending stocks from a global standpoint, there's been this attitude that they've been burdensome, which pushed us down below that $4 level and beyond, into lows that we hadn't seen since prior to that 2006 timeframe. But once you start to look at the overall supply economics or who is holding on to the world's supply, China has 52% of the world's wheat. Before, we could ignore that simply because we had an overabundance of supply. Black Sea region was providing a significant amount of wheat, and their production seemed to be growing every year. Russia became the number one wheat supplier to the world here last year. Australia, same thing. They had grown in production. But now we're starting to see these areas that we had relied upon to really kind of push the U.S. into the residual supplier role are having these production issues. Russian production looks to be significantly lower than a year ago. We're still trying to get a finger on what that looks like as they work their way into harvest here. There's been a lot of extreme issues with drought in Europe, Germany specifically, and they're a large provider of soft red wheat, as is France, where their quality is dwindling. Australia's had the driest summer that they've had in quite some time, actually. It does look as though last year they had a drought-crippled crop come through, and it looks as though the start to their crop this year is much worse. Now, of course, they'll harvest this winter sometimes, so we're way away from knowing what that looks like. But these countries that have been big producers are now starting to see some production issues, and that's definitely helping keep wheat supported simply because we don't have that safety net we had. And when it comes to world wheat demand, we really are only one crop scare really away from not only chewing through that surplus and supply that we thought we had, but actually creeping into where we may have to ration some demand. So it's definitely a hair trigger type situation in wheat right now.
So, Angie, just in a bigger picture, though, do you feel that the lows of wheat are in? Is it really more upside here from these lows where we're currently trading?
The potential is there, yes. We could see some downside pressure start to take place if outside market watchers pay attention. The spring wheat market has a little bit more of a negative tilt to it versus your winter wheat market. So your Kansas City and your Chicago, we have the three different types of markets there, and there's different setups, supply and demand setups for each. However, you can see the spring wheat interchange with the Kansas City. So to me, looking specifically at Chicago wheat, which is what you will see trade for the European wheat and a lot of the Australian wheat, to me, I feel that the lows are in place. Not saying that we won't retest, some of that 483 type action, maybe even 475 if you look at the front month. But to me, I think the lows are in place and we'll find support as we work our way through and get a feel for what we're actually looking at when it comes to overall production potential globally.
Angie, as Patrick described in the last question, we've seen wheat looking like maybe it's bottoming here. It's pretty much held its own all year. And if I look at corn and soybeans, they looked the same way too until about the last week of May. And then, holy cow, at the same time, both corn and beans just took a nosedive, plumbing new lows now. Did something happen the last week of May? What's going on here?
Yeah, it became a very painfully obvious trade that started to develop. So there's a plethora of things that you could point at. Of course, the most obvious being the trade war, the concern over what was going on. We could not come to an agreement when it came to NAFTA. And you actually saw the Trump administration kind of heat up the rhetoric that was going on, when describing the NAFTA negotiations. And Canada and Mexico are number one or in the top 5 when it comes to ag exports across the board. So they're very important allies to have. And there was a concern that came into play with that. A lot of folks thought that we would have the Chinese trade spat put to bed much earlier than June 1st, and especially didn't think we'd actually see the tariffs come into play and actually be put in place, let alone see them ramped up with that additional $200 billion added here a couple weeks back. So you really started to see, two things. First of all, over the last couple years, if you shorted grains and soybeans early and went home, you were far better off. And we've seen the over the last couple years earlier lows. So we would see first it used to be the middle of July, and then it was the first week of July, and then it became the last week of June. And so we did see a weather pattern indicate that we would see substantial rainfall throughout much of the Midwest. So you saw the idea that weather was going to be conducive to record production. Many market analysts out there were already adding yield to their production estimates, mid-June. So you had headline, negative headline, just something that I call it a slow motion black swan event for grains, where every headline, every article that you read is negative, and you don't have to know much about commodities to think that shorting them would make sense based on the trade rhetoric, good weather conditions, all of these things that we're seeing. So you really saw the market kind of really trip over itself to get short, and in soybeans, when that starts to happen, it's really easy to liken it to a boulder rolling down a hill, and that's what we saw. We've lost over $2 in beans and 60 some cents, 70 cents in corn. It's simply because of the negative headline tone and the concern over what could happen as we work forward when it comes to trade, because agriculture seems to be the bullseye, at least at this point in time, when it comes to China specifically. But we saw that happen, and then we saw the idea of good conditions. We're now starting to see some transition and thought take place, but it's like turning the Titanic at this point in time unless we see some sort of really exciting announcement come from the administration about what we're seeing with trade.
Now, Angie, we have to really ask the question, what has the impact of these tariffs that Trump is putting in impacted the grain markets? Is this really the driver of, or is it something else?
I definitely think it's the driver. I mean, you could ask 5 different people and get 5 different answers. Of course, weather played a role, the idea that yields were increasing, but I feel that it's much too early to know what we're going to see from an overall production standpoint, especially when it comes to soybeans. The tariff issue is a big one, and we really don't know. To me, I think right now what we've seen is a result of short-term headline risk. I think long-term we find that it weighs out. And that while the issues are there and there are long-term concerns with what could happen with our Chinese trade, I think the demand that we see for protein worldwide, I mean, developing countries continue to grow wealth in developing countries also grows. So even if China doesn't remain our number one customer, I think we'll find that the demand for our soybeans remains relatively strong, as we move forward. So I feel that long-term wise, the impacts may remain or may be visible, but I don't think they're going to be near as deep as what a lot of folks are thinking they will be at this point in time. I think when it comes down to it, once a population discovers meat and other protein sources like they have, it's very difficult to go backwards when it comes to your dietary preferences. So I think that they're going to play a major role in what we see happen as we move ahead. But it's definitely something in the short term until we find a different thing in the trade to focus on. Perhaps if we start to discover that there's production issues or something like that, you'll see people pay attention and come in on the buy side. At the same time, we are starting to see volume kind of tick down a little bit as we work towards these lows, which indicates that the trade's just not as exciting as what it was before, at least to me. So I think we'll start to see people kind of get bored with the idea that they need to short grains every time they see a tariff headline. And we probably, at least hopefully, will be able to get up off the mat here.
Angie, let's tie this all together. Grains have been selling off awfully hard for a long time now, for what's it, 6 years or so. Are we at the point now? Because it seems to me like you could kind of make a macro argument here that, boy, we've got profound sell-off over the last few years that's been exacerbated, particularly in corn and beans in the last couple of months with this trade talk stuff. And we do think that maybe inflation is not too far around the corner. Seems like maybe there's an argument to be made for, hey, grains are bottoming. It's time to make that long-term strategic play. And I guess the part one of the question is it that time, or do we have further to go to the downside? And if it is that time, are the grains themselves the place to make the play, or do you want to be in the equities? Because obviously, as you know, you get into a longer term, something like, say, the DBA ETF tends to get eaten up in contango tracking error so much that you're maybe better off in the grain producing equities than the grains themselves, unless you're trading them with a shorter time horizon. So is it strategically long-term time to get bullish on ags? And if so, are the grains the place to do it, or are there better places to invest?
Yeah, to me, I think so. I think corn is really what I'm paying attention to when it comes down to it. I mean, looking at corn, for one, the Chinese trade issue that we have developing, it will not have as big of an impact on corn as it could on soybeans. If you're looking at a long-term trade war developing where we start really sharing blows with one another, then corn is a little bit more open to going other places. On top of that, looking at current supply and demand situation without any sort of reduction in our current production outlook, you look at the global supply and demand setup. Right now, the U.S. is the only supplier really with available supply of corn to the world. Secondly, you look at expected supply and demand economics and carry out, what's left over at the end of the marketing year next year, which would be September 1st, 2019, looking ahead. And we have the tightest available supply of corn since the mid-70s. So we're using and chewing through those stocks. So from an overall, if you're a supply and demand fundamentalist and looking at what is taking place, what is shaping up with the current market structure, I think corn long-term is a good one. I also think, though, if you don't want to get into the agriculture or the grains specifically, getting into the handlers of these grains would definitely, I think, pay off perhaps long-term, maybe looking at some of these outside market structures. But to me, I specifically trade in the commodities themselves, and I would not be afraid of owning December corn at these levels. It's simply because you're nearly 5 months away from having to make that decision on the roll into the carry market setup. Soybeans is a little bit different simply because we're still about 4 weeks away from knowing what we're looking at production-wise. August is the month that will make or break the soybean crop. So we'll definitely want to keep an eye on weather there. If it does look as though the weather is going to stay warm and dry through the next 4-week time frame, then soybeans definitely should also see a significant move higher. The problem with soybeans right now is that the USDA did take a big chunk of export demand out, saying that it was a result of the tariffs. So there's a lot of unanswered questions there, and uncertainty always favors the bear, at least it seems to, in grains and oilseed markets. So to me, if you were to say, Angie, what do you think is the best long-term trade? And by long-term, I mean 6 months to a year. So maybe you guys definitely look at long-term as a different market setup than we do. But corn is where I think the real bullish excitement could come into play, especially if we start to discover that the crop's out there which we're starting to see. There's been a lot of production issues. We had the warmest June on record. In a lot of places, overnight temps have been really high, which tends to limit corn production. And so there's a really good possibility to see an explosive move higher in that market here over the next couple months.
Well, Angie, thanks so much for joining us on the program. Before we let you go, please tell our listeners your Twitter handle so they can follow your work.
Yeah, it's Goddess of Grain. That's where most of my information comes from on Twitter, and that's where you can find me.
Thanks so much.
Thanks for having me.
All right, Erik. Let's go back to that interview that we had with David Rosenberg. And I just wanted to get your impression on what he said. But what I found most fascinating about it was that, we tried to kind of get him to speak to the idea of where things are with junk bonds. But he didn't seem to be that concerned about junk bonds, where all of his attention seemed to be focused is on investment grade bonds, and particularly the very large amount of low grade investment grade bonds, the triple B rated ones, that lower tranche. And what's particularly interesting is at least what I took away was that he thought the big risk obviously was the downgrade that could potentially happen on these, like that fallen angel story. And his trade idea nonetheless was this idea of shorting those investment grade low tier ones against going long some of the higher quality ones. I thought it was really interesting that was where his focus was. What did you take away from the interview?
I agree that the idea of a pairs trade, short triple Bs and long triple As, makes perfect sense. The problem is I don't know how to put that trade on without having the ability to trade over-the-counter derivatives with an ISDA account that, most people don't have the ability to do unless they're running a large fund. So, to me, it still is a pairs trade if you want the pairs trade, long treasuries, short junk. And I agree that his idea is much better. I just don't know how to put the trade on. The thing that really stuck out for me, though, from the interview overall was that quote on page 3 in the slide book from Jeremy Grantham, where, he says clearly all the smart guys need to be able to see that this should, emphasis on the word should, be over now. It should be done. It's time for the market to go down. Bull market should be over. But guess what? That's exactly when the market loves to fool people, and you get that one last big speculative hurrah. And it made me think about the way the stars are kind of lining up here. You've got the point now that we've reached, you can easily make an argument for a target close to a retest of the previous all-time high. If you're just coming up on that and Pippa Malmgren's scenario comes true, which is, let's say President Trump gets what he wants out of these negotiations and backs away from all of the trade war rhetoric and so forth, and we find out that was really just art of the deal stuff and he didn't really mean it, and that everybody's jumping for joy, that reinforces things, that pushes us to new all-time highs. The act of getting to new all-time highs and clearly showing that this was a correction and it's behind us now begets even more buying, and you get that one last mania wave in the bull market before the blow off top when it's finally over. And as you heard David Rosenberg say, he thinks that no, the blow off has already happened. It's over. It's done, behind us. I kind of tend to lean towards David's side of this, which is probably more likely the top is in and it's over. But boy, Patrick, I could very easily see the other scenario, especially if the news flow just happened to come together in the right way and, the dominoes line up, the stars come into alignment, whatever metaphor you want to use, and we get to new all-time highs in an environment where everybody's breathing a sigh of relief about trade wars at the same time. And I think that could take us considerably higher. So that really begs the question, and that's why I want to get into your chart book, which is how do you hedge significant tail risks when you think that there could be room for a really big move in either direction? Listeners, you'll find the download link in your Research Roundup email. It says Postgame Chart Book. Patrick, why don't we go and starting at page 2 here in your book, where you've got a 4-hour chart of the S&P. We're not quite in that target breakout zone, but we're above that big blue rectangle that you have drawn here. What's this telling us and what comes next?
Well, really, I just wanted to continue with an update on the 4-hour chart that we continue to show as often as we can in each of the episodes. And really here, I mean, we talked about just a technical measured move to the upside. Obviously, that in itself doesn't guarantee anything. That's just where a lot of technicians are targeting some of the upside moves. I'm really watching what happens here. We broke out above all the previous highs. It's interesting. The NASDAQ and the Russell are participating, and the Dow has not confirmed this. And so you've got a mixed bag on a lot of these indices. To me, I've not seen from the price action any evidence that the buy on dip traders are done. And so even if we have little short-term shallow throwbacks, I'm still in the camp that this market keeps trying to edge to the upper end, but that doesn't change my much bigger picture view where I pretty much align with David's view. I've been suggesting that this is one big topping formation developing all year long, whether it pokes its head to an all-time new high or whether it fails just below. I mean, those are just the unique characteristics of every bull market top that kind of ambiguously form a little bit differently. But I generally don't believe, from a balance of probabilities assign, a huge weighting to this blows out to the upside. But, we still have to obviously leave that on the table. Anyway, bottom line, I still think that the market could edge higher, but the whole point of this is that we are approaching the top end of this range. And that is a really interesting thing because the volatility index, gravitated down to the bottom end of its year range. So the VIX was relatively low. I mean, it's right around the 13 handle right now as we speak, a little bit higher since the market pulled back a little bit. But this is usually as the market rallies toward highs when it becomes a really good strategy to consider hedging tail risk. And this is the conversation I wanted to have because a lot of people ask, well, first of all, what does it mean to hedge tail risk and why would one do it? Hedging tail risk is this idea of, well, I don't want to remove all risk of loss or overpay for protection, but I want to protect myself from the idea that this market can have a 1987 style event or a huge bear market resumes where suddenly the stock market, faster investors are ready for it, is down 20-30%, and you're taken completely out of your comfort zone and forced to panic out of your positions. And so one of the ways to approach that is to buy the tail hedge risk, to buy some protection that removes the risk of catastrophic loss if there's a move. Usually, and often, tail risk usually lies about 10% or more underneath the market. And that's where I wanted to really take this conversation, is this idea of, well, what does it look like right now to buy tail risk insurance, right?
Okay, Patrick, so we're talking about the S&P 500 is what you're going to use as a hedging instrument. Now, there's two ways to do that I can think of. You could use the options that are available on something like the SPY ETF. Those are American-style options that can be exercised at any time during the life of the option. You could probably pay a little bit less in premium if you went for European-style options, which are available on the index itself, which is the SPX index options, and those options, they have to be exercised at the time of expiry. You're not allowed to exercise them early, and that changes their characteristics. So which one do you use for a situation like this?
Well, I want to highlight one thing. While a European-style settlement cannot be exercised early, the SPX options are incredibly liquid, and you can buy and sell them anytime. So in theory, if you buy a 9-month hedge or a 1-year hedge and 3 months in you want to cover, you can just go into the market and close it. Maybe in a very illiquid period, the spreads might blow up a little bit and you have some slippage on your fill prices. But generally, you do have a liquid market to go into. So to me, when you look at the implieds on both the SPY and the SPX, there isn't that much of a difference. I mean, a lot of arbitrageurs bring that closer together often, and a lot of the short-term benefit of one over another is inconsequential. But to me, it's a bigger question. If you're using the SPYs, usually, if I let's say have a portfolio and 30% of my investment portfolio is actually physically in the SPY, and I'm invested in there, then actually buying the SPY tail hedge makes a lot of sense because then that's an absolute hedge for where you have a guaranteed sale price. But most people that do tail risk hedging often have a fully diversified portfolio, and they hold a whole array of investments that have different correlations, and you could determine your beta weightings or your volatility weightings in the portfolio. And you turn to the European style index options as the way to do this, because by having the ability to settle in cash rather than delivering the underlying, it allows you to have no risk of a tax dispositions on expiration, and that could trigger taxable events or interrupt your dividend streams from the stocks that you own. And so when we're talking tail risk for a whole portfolio, most people tend to head toward the SPX. The other big difference, of course, is the SPX has a much larger number. So you're hedging for every contract, $250,000. And so a lot of smaller investors tend to go with the SPYs just so that they can size their hedges better by being able to work with a smaller multiple on that. But generally, and in this case, we are going to focus on the SPX cash European style index options.
Okay, Patrick, so let's move on to chart number 3, where you're showing us the implied volatility, which is, of course, a way of expressing the price of these options. What's this chart telling us?
Well, most normal investors are just simply watching the VIX itself, which is a reflection of 30-day implieds on the S&P. But when you're actually talking about options, each month series has its own implied, which is reflecting the different risk variables on different time frames. So what we have here is the implied volatility on 4 different options. We have the October series going out 90 days. We have the January series going out 180 days in orange. We have the green one, which is going out to June of next year. And then we have the blue one, which is going out to December of 2019, so almost a year and a half. So what you're seeing is the different levels of implied. And I'm not trying to focus on this from that cost perspective, but in general, what we can take away when we look at this, no matter which one of these options we look at, we're pretty much trading at the bottom end of the range of 1-year volatility. So from a volatility perspective, just at the money right now, be able to buy hedges for a very reasonable cost.
So if it's reasonable cost, presumably it makes more sense to buy a longer dated hedge, lock in that good price, as opposed to buying a shorter dated hedge that you might have to roll forward in less favorable pricing when you get to the time to roll it forward. Is that right?
That's right, but at the same time, you're upfront paying a little bit of a higher vol premium for that longer dated one. The market tries to right price everything, and so these spreads tend to reflect what the marketplace feels is the right price to reflect those different risks, right?
Okay, Patrick. So moving on to slide 4, we're looking at the multi-expiry skew, and what that's measuring is how quickly the price changes. In other words, the price gets more expensive on a volatility basis as we go further out of the money. And it seems like it gets a lot more expensive in terms of higher implieds as we get toward that 10% or so, which you're describing as the tail risk. So tail hedges are kind of expensive right now. Zero Hedge just had a piece today about this, saying, okay, if everything's so rosy, how come people are paying more than usual for downside tail hedges? So is this a good time to be buying that kind of hedge, and is there a better way to approach the market?
Well, you're absolutely right. So the Cboe Skew Index, which is measuring how much premium you're paying out going out of the money on the tail risk, that Skew is actually near year highs. And in fact, it's actually near multi-decade highs as we approach toward the 140, 150 level, which means that the left tail on options are getting more and more expensive. And that's because the options market tends to right price options based on supply and demand flow. So as more and more people are seeking out that tail risk, then the price of that tail risk increases. It's a supply and demand element that way. And so right now, what we can identify is hedging tail risk is getting more and more popular. There's no doubt about that. But in my mind, even if it's getting more and more expensive, doesn't mean that you shouldn't do it. If you subscribe to the view generally that the market has downside risk, I mean, it could keep rallying into the summer and keep moving higher, but at some point, the market is going to turn. Having a hedge is still a worthwhile exercise. And this is where we'll talk about the cost of the hedge and what that looks like. The key reason why I like tail hedge risks is the psychology behind it. I ask a question to our listeners: how many of you investors, not traders, because traders are always in and out of the markets based on their tactical views, but how many of our listeners that are investors are underweight stocks or completely out of stocks simply because they feel that the market is incredibly expensive and something bad will happen? And how many of those investors have missed the last 10-20% of the stock market rise because they were so worried about the big picture fundamental view? This is why, from even just a psychological perspective, why tail risk is so important, because in the late stage bull market, what is always amazing is how long a bull market lasts and how far it goes. It always shocks investors how far it goes. And so the only way to participate during that late stage of a bull market is to stay invested. But how do you stay invested and not know that you don't get stuck holding a hand grenade in your hand and get badly burned for overweighting your stay? And this is where that tail risk hedging comes really into play. Nonetheless, the one thing I wanted to really take away from this is that even though we see the VIX down at 13, and if you go to the different expirations at the money, you're seeing, most implieds around the, 10 to 15% range. When we move out 10% lower on the market, I use, just for the round number purposes, 2,500. It's a little more than 10% away, but for the purposes of this example, it's perfect for what we want to do. So what we're doing is saying, I don't mind the volatility of a 5% or 7% drop. What I don't want to experience in my investment portfolio is if the market goes down 15 or 20%, I sell my $1 million portfolio worth $800,000, right? That's where investors lose sleep at night. And so by going out there and buying that tail risk, you can remove the scariest part of a market drop for your investment portfolio and stay invested. That tail risk cost lies around the 19% premium. And what's interesting is that about 10% lower almost all of the time horizons, whether we're talking October, January, June, or December of 2019, we're in a scenario where all of them are coming in around the 19% implied volatility for that option.
Okay, so let's put this in hard numbers. Suppose that I want to consider a 10% tail hedge so that I can be comfortable and sleep at night, staying in the market from a long position so that I can participate in that upside. I'm going to basically make sure that I have a hard stop at a 10% loss. Anything more than 10% down, I am fully hedged against, so I don't have to worry about it. What am I paying on an annualized basis to carry those hedges? How much am I losing each year in the premium cost of buying that insurance?
So this is where what we did on page 5 is we are showing what is the current bid and ask on buying $2,500 strike S&P options. So we're going about 10% out of the money, and how much would it cost? Now the cheapest, of course, because you're paying for time, will be the shortest one, which is October, about 91 days at the time of this recording. That more or less was around $14, which is about 0.5% for 90 days. So that annualizes at about a 2% premium to hedge. Now that when someone looks and compares October to January, which is 180 days, you're now saying, well, to get double the time, it actually is more expensive to go to January. It's about $34 on the asking price to go out to January and get a half a year of insurance. I bought in October for $14, and if everything's fine out in October, I'll buy another 90-day one for another $14. It ended up being cheaper. But the thing is that it might be cheaper, but it's also incredibly more complicated. The market can be making all sorts of volatile moves, and you may not have the same vol conditions nor have the same distance from the strikes to buy hedges when October rolls around. For the certainty to know that for the rest of the year you're hedged out, there's an additional little premium for that, but it's still, in my mind, it's about 1.2% of the portfolio just to remove risk for the rest of the year if something nasty was to happen. But if you move on to about a 1 year one, the June one goes out to 336 days, so it's 1 month short or 11 months out, we can see that the cost goes out to about $66. So that's just north of about 2% cost for just about a year of insurance. So more or less, whether you're going 90 days at a time and you want to game it, or whether you're going out a half a year or a year out and paying it out, more or less on an annualized basis, you're approaching somewhere at this moment around 2% cost to buy that insurance, and 2% seems like a lot on the surface. If you kind of put it in the context of what your performance is in cash versus you being able to participate on further upside of equity, for some investors, staying invested in the markets and the opportunity to make big gains is worth paying for that tail risk.
Okay, now let's make sure that we understand what that actual trade-off is, because if the market crashes, you're going to lose 10% and you're going to have paid 2% for insurance that protected you after that. So really, you ended up losing 12% if the market crashes. That's your worst case to the downside. On the upside, the first 2% that you make is going to go to pay the insurance, and then you get to keep everything after that. Is that pretty much the summary?
That's pretty much. That's always the debate in options. You're always paying premium for certainty. And that, as options, that's what we're always looking at, is what is the cost of creating certainty in the markets? If David Rosenberg is right, and we have already seen the tops in the markets, and we're not going much higher, well then, some investors may just be compelled to unwind their long exposure and move in cash. But those that, subscribe to a far more bullish view and think that there's still one more big leg coming, rolling a tail risk hedge while staying long the market is still, even though that Cboe Skew index is at the top of the range, it's still, in my mind, not unreasonable to do this.
And how would you compare that with the other option, which is to get completely out of the market in terms of closing your long positions in equities, but using a little bit of money to buy some at-the-money calls so that you can participate in the upside, maybe not quite as much as you would get from a fully invested position, but presumably in that case you've got a lower downside because you're not going to have spent 12% of your portfolio on those calls. So how do you balance the option of using calls to participate in the upside versus staying invested and using puts to hedge the downside?
Buying calls on an implied volatility basis would be much cheaper. The call vol is actually cheaper. There's always a skew, and not always a skew, but there's often in the S&P a skew in that ratio. But in that case, though, because you are buying at the money, you're paying actually a much larger amount up front. So you might end up paying 3, 4, 5% for an at the money call option at a lower implied. But now that is your absolute risk. It's not a bad approach. Using call options as an alternative to owning the underlying is fine. But a lot of people that hedge tail risk do so largely because they don't want to sell the stocks they own, often because of tax considerations. If you've owned something for the last decade and have massive capital gains, and the actual physical sale of those things prohibits you from doing it because you just know you're going to get hit by the tax man in a big way, often they turn to this tail hedging. Of course, if you don't really have any big tax considerations, then you could always, of course, close your existing positions and continue to bull the market on the upside with a rolling call strategy for sure.
Okay, and finally, moving on to slide 6, I've seen quite a bit of people writing on the internet about this uncanny correlation between gold and the Japanese yen. I'm not sure I've seen anybody really conclusively explain precisely what's causing it. What's going on here in this slide, and what's on your mind?
Yeah, I got an email from one of our regular listeners, Huey. I just want to do a shout out for you. And he kind of just pointed it out to me and asked, if we had any insights on it. And to be honest, I'm just actually baffled by how strong of a correlation this is. Like, I always look at gold as a cross currency to the US dollar, but why is it so strongly correlated to something like the yen? And, I've often looked at correlations of gold to things like the Canadian dollar and Aussie, which has worked for a while, but this is really stuck. The reason I put it in there is that, I'd really love to have this conversation in greater detail. And so I'm doing a shout out to our listeners to help us, find anyone that would give us insights on this, or any articles or anything that helps further explain this. Because I would love to have a much greater and deeper conversation on this. I just don't know where to start with it.
Patrick, I would love to have a decisive and clear answer to this. I've heard a lot of different people speculating on why they think there's such a strong correlation. Obviously, the yen is moving opposite the dollar and gold is moving opposite the dollar. There's got to be some correlation there. But, if you look at the correlation of gold to the euro versus the dollar and you look at the yen, boy, it is just so closely tracking the yen. And I suppose it probably has something to do maybe with the yen as a carry trade currency. Maybe that has something to do with it, but I'd love to hear the decisive and definitive answer. I've yet to hear that one. And finally, Patrick, I just want to mention on slide 7 here, you are still offering our MacroVoices listeners a free 7-day access pass, no credit card required, no strings attached, to check out Big Picture Trading, which of course is the service that you offer to your subscribers. You do webinars 4 days a week and provide a very comprehensive trading advisory service that I definitely encourage our listeners to check out. And they can do so by emailing info@bigpicturetrading.com. On that note, let's call it a wrap. Folks, we do need your help promoting and telling your friends about MacroVoices. We are still growing, and we need to grow more in order to bring you even better feature interview guests, because that statistic of how many registered users we have is what Patrick uses to lure in the very best feature interview guests. It only takes a minute of your time to go to macrovoices.com and register your free account. The benefit to you is you'll receive our free Research Roundup email every week. That gives you the download links in order to get the downloads both as an association with this program and for all of the best research that we could find on the internet each week. Patrick, tell them what's in this week's Research Roundup.
All right. Well, first, you're going to find a transcript between yourself and David Rosenberg as well. You'll find the links to the chart book that both you and David discussed during the interview, as well as the post-game chart book that we just discussed at the end of the show. There's also an interesting article from Jesse Felder about what the buy and hold cult does not want you to know. There's also a great interview with Victor Schvetz on the market telling the Fed that tightening must stop. So you'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we'll include it in our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend and myself at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.